Want to retire a millionaire without chasing risky stocks or winning the lottery? The hidden secret is not in a Wall Street playbook. It begins with one simple move: taking full control of your money. According to the professional financial expert Dave Ramsey, the ultimate wealth-building tool is not luck. It is your paycheck, your money, and how much of it you keep. In this video today, you will discover how getting rid of debt, investing consistently in proven mutual funds, and avoiding common financial traps can result in real wealth. Welcome back to our channel. The topic of today's video is Dave Ramsey's timeless investing philosophy, specifically for beginners. Known for his strong belief that the borrower is slave to the lender, Ramsey emphasizes that an individual's main wealth-building tool isn't luck or a stock tip, it's their income. The less of that income is tied up in debt, the more it can be invested for long-term wealth. The debt trap. A $503 obstacle to $5 million. Ramsey reveals a shocking truth. The average car payment in the USA is $503. This single monthly payment, if redirected into a good growth stock mutual fund from age 30 to 70, would potentially grow into over $5 million. The crucial thing is consistency. He believes that escaping debt isn't just about short-term relief. It's the quickest road to retirement security, wealth, and generational change. The problem with traditional financial advice. Ramsey often criticizes the financial industry for concentrating heavily on investing without addressing the foundation, discipline, and debt freedom. While a lot of financial experts, bloggers, and advisors have different opinions, Dave Ramsey points out that only a few of them have a strong financial track record themselves. A lot of financial advisors and experts make their money serving the top 3% of their wealthy clients. Ramsey's approach has always been about teaching common people what real millionaires actually do, not just theory. The Millionaire strategy: growth stock mutual funds. So, how do millionaires go about investing? According to Ramsey's research, they keep it simple. They invest in growth stock mutual funds and accordingly spread their investments across 4 different categories: growth and income, large cap, stable, blue chip companies with low volatility, growth, mid cap, medium-sized companies with solid performance, usually tracking market trends, aggressive growth, small cap, startups and small businesses that are high risk, high reward, international, non-US companies for global diversification. Ramsey advises to select mutual funds with a proven 10-year track record and recommends those which consistently outperform the S&P 500. He thinks that while index funds like the S&P 500 are good options, there are many actively managed funds that do even better if chosen wisely. His advice? Check out a fund's prospectus to compare its performance to the S&P 500. If the fund consistently underperforms, don't go for it. Why paying a fee for a professional advisor can be rewarding. Many people question Ramsey's recommendation of loaded mutual fund, those with commission fees. His answer is simple. People with a financial advisor are highly likely to stick with their investment plan. The advisor works as a guide, particularly when the market fluctuates or plunges or some other mishaps happen. Without that guidance and accountability, you as an investor are likely to pull out at the worst times. Ramsey believes that an expert human advisor, who acts more like a teacher or friend than a salesperson, is a valuable ally for long-term investing. The power of consistency. One key statistic Ramsey shares is that 74% of retirement success comes from one thing: actually doing it. Saving regularly, contributing to a 401k, and investing month after month is more significant and essential than chasing high returns or choosing the perfect fund. Ramsey chooses funds based on long-term performance instead of hype. About 80 to 85% of his decision is based on the fund's historical rate of return. For instance, if several funds have given similar returns in the past few years, he decides to go with the one with the most stable and longest record. A closer look at the 4 mutual fund types. To recap, Ramsey's recommended mutual fund categories are growth and income. These low volatility funds consist of well-established companies. Think of them as the financial equivalent of sturdy oak trees. Growth. These funds are for mid-sized businesses and are more volatile. They follow the market trends closely and can outperform if selected carefully. Aggressive growth. These are the high-risk, high-reward funds with small cap or emerging market companies. Dave Ramsey warns that while they could give good returns, they can also plunge lower when the market goes down. International. The international mutual funds include foreign companies, providing essential diversification. While generally underperforming in comparison with American funds, international funds helps with diversification and reduces overall portfolio risk. He even recommends considering global funds, including both US and international mutual funds and companies, as they often perform better than strictly international ones. Final thoughts. What is the bottom line of Ramsey's investment philosophy? Do it and understand it. Don't invest in something you don't understand at all. It is your hard-earned money after all. People are often misled or exploited when they blindly trust others. Whether it's investing, mortgages, insurance, or estate planning, understanding the subject is the most vital aspect for you to consider. Celebrities, athletes, and everyday investors alike have lost a lot of money for not tracking their money. Ramsey compares investing to parenting. You have to make your money behave. If choosing help, seek someone who teaches you, not just sells to you. Ramsey further explains that he would be an easy sale once he understands something, but until then, he doesn't spend a dime. That principle has helped countless individuals and families build wealth in the best way possible. What's your biggest takeaway from this investment strategy? Let us know in the comments. If you found this video helpful, don't forget to like, share, and subscribe for more content that simplifies money and investing.